trying to do is have some money still in the stock market so that we're outpacing inflation nicely over time as inflation drives up their living need.
Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Let's go. Hello, everybody. Welcome back to another show. The Ideal Investor Show is with you again. And today we have a great guest, and we already blabbered for almost 25 minutes before we even hit record. Tim Smith is with us from Aurora Wealth, right? Did I say that right?
Aurora Private Wealth, yes.
Aurora Private Wealth, not just Wealth, yes. Private Wealth. Tim, welcome to the show.
Thank you very much. Thanks for having me. I'm glad we didn't waste a lot of good stuff already in the in our pre-chat.
Oh no, absolutely. The good stuff is coming for the audience.
Good,
now.
Okay, good.
Just this was totally like college and private chit chat and so forth. So before we dive into Aurora Private Wealth, tell us a little bit, how did Tim get to where he is right now?
Sure, circuitous path. I was a child actor singer. And I acted in television commercials and regional theater and musicals and opera. Gave it up when I finished college and I studied basically theater, film, television. Gave it up to go into a business career, primarily in the investment world, because I was investing money that I made as an actor, and I found it more fascinating than acting, I guess. So I started as a frontline financial planner, got my certified financial planner designation, started in 1985. This is my 40th year. And 10 years after I started my own, I left another company and started my own investment advisory company. Some friends wanted to join me, and I started a broker-dealer for them. And that broker-dealer then became a large part of my business. Today, we have about 100 financial advisors in 60 offices in something like 37 states. And so I run the company, and I also manage money for about 25 clients. And, I started something called The Financial Dad, which is about financial literacy for young people and entrepreneurs. On the side, I still do a lot of singing work and, just trying to enjoy life, wife and 3 kids, so. And a grandkid. Okay. Got to remember the grandkid now.
Yeah, me too. I have one too now. Yeah. Okay, very cool. Now, I have to do it, Tim. I have to do it. For the audio only crowd, I have to say, Tim is not related to Will Smith.
Oh yes. Well. If you could see me, you would know, but okay.
All right. Yes. I was just about to say it would be very obvious when
all the Smiths are related somehow, though, back in the day, by profession or by DNA. I'm not sure.
Well, it could be Adam.
Well, I'll take that one.
That was a little closer, right?
a little economic theory time,
Yeah, exactly. So for Aurora Private Wealth, what kind of clients are you serve? I mean, if anybody in the audience is saying, "Oh man, Tim Smith, I always wanted to work with him," what do they need to bring to the table so that you say, "Yeah, you're the perfect client"?
Yeah, well, I target portfolios between about $3 and $20 million. Typically, people who are concerned about risk protection. So I use a lot of puts and calls and structured notes in addition to ETFs and sort of the normal financial planner-y kind of stuff. But what I do is I provide risk. We can literally give people riskless portfolios if they want to go that far. There are some tax consequences to that, but so that for me is most of what I handle. The firm works with people, typically the mass affluent, people with $250,000 to $10 million, that kind of range. So we're like a mini Merrill Lynch. We have all the access to things that people would have from a very large firm like that. We partner with institutions like Schwab, for example. And so we get access, our clients get access to a wide variety of things that we would not otherwise be able to provide.
Okay, well, that's a good point, because that leads perfectly. And for the audience, we didn't plan it, but I was literally just thinking to ask you, what would then be the difference to a family office?
Okay, well, a family office is normally focused on things beyond just the general financial planning. So, for example, they will pay your bills in many cases. They'll handle tax returns. They will, if you're going to buy a house, you would say to them, I've chosen a house, here, go get it. And they often have power of attorney for their clients to transact business things. On my side of the world, and by the way, when you have power of attorney, it typically involves something called custody, which means you have ultimate control of the disposition of the client's funds. So you can literally write a check, and move money around and things like that. In my side of the world, we don't do that. We don't take any custody so that the client is protected. In a firm of my size, unfortunately, I've had to clean up a few fraud messes, which is how I wrote a book about investment fraud and protecting yourself against investment fraud. So when you have 100 financial advisors or more, unfortunately, somebody's going to be a bad apple at some point or do something stupid at some point.
No, you don't tell me that people could be greedy.
or desperate, or both.
Or desperate.
Bad financial advice. The last guy you want as your financial advisor is the guy that just declared bankruptcy, right? So.
But I mean, that is probably easier. One of the easiest ways to handle. I was more thinking, if you have a commission-based model, and the greediness gets you to advise only in the most fee-rich direction. Let's put it mildly.
Oh yeah. Well, there have been some industry changes that push back against that compensation model. The vast majority of our business is fee-based or continuing revenue rather than transactional. So, as an example, I don't think we do 200 stock trades a year, honestly. The vast majority of it is fee-based asset management or trail-based compensation, which simply means that as long as you're happy and I'm still your advisor, I get a small piece of your investments from the product sponsor, whoever it is, in return for servicing you and giving you advice ongoing and that kind of thing. So it's a little bit different from a brokerage concept.
Right, understood. No, I was just kind of teasing a little bit. Now, the other thing is just to clarify, since you're an expert in this, it is possible to have asset class custody and not just a whole portfolio custody, right?
Yes, I mean, you can have custody in any broad or limited fashion. We have to also distinguish between discretion and custody.
Right.
So discretion means that the money sitting at a Schwab, that I have the power to buy or sell things for you. It doesn't mean that I have the power to move money out of your account. So
and that would be like if you say you have like a stock as an asset class, right? And you say, okay, within that, we're starting out right now at 3 million and we want you to help us for the foreseeable future. And, like the goal is to grow it, and you can maybe put some more bells and whistles on the rules. But then within that frame, you can do everything. But if they also have real estate or Bitcoin or gold bars or, I don't know, jewelry, or I'm talking,
and they do.
Or like, and I thought, or I expected you would say, well, in a family office kind of scenario, besides taxes and paying bills, would also be like private equity deals and stuff like that.
Yes.
That go beyond the pure investing, so to speak.
Yes, and in fact, in a lot of family offices, they will bring private equity deals to the family and suggest them and vet them, and they act almost like mini investment bankers for the family in that regard.
Right. Yeah, exactly. Well, I'm also bringing it up because in our business, even though our focus is on real estate, we have found more and more, and we're not family office, and our clients start more in the low six-figure asset value range. But we're finding more and more that establishing corporate structures and holdings and trust and foundations and these kind of things become part of it, not just for anonymity and legal protection, but also just because if people have a longer term relationship or a longer history already from a family perspective, there's just more things to arrange that are not really directly related to, in our case, mainly real estate investing, or like, I guess in your case, mainly stock market investing.
Well, and all of those various approaches, like an entity that handles the family's investments, trusts, things like that, make estate planning easier, because when someone dies, you don't have to go through the process of probate with the assets, and transferring assets, especially with trusts. Like a living trust is a terrific vehicle from that standpoint.
Yeah, absolutely. Now, you mentioned risk earlier a little bit, and I'm kind of wondering if we look at this on like a age timeline, so to speak. Can you tell the audience a little bit, for your specialty, how you would basically start adjusting the diversification based on age?
Sure. Well, I mean, if somebody's in their 30s and 40s, and if we've done some sort of a rough retirement projection for them, and they're spending $100,000 a year now, what will that be in 20 years when they want to retire? How much are they saving now? What will that be in 20 years? What will Social Security be? Hopefully it's there. We can get an idea of how aggressive they need to be in their investments. Some people want to be aggressive whether they have to be or not. Some people aren't going to get there over 20 years if they're not aggressive. So
Right.
aggressive to me means, by the way, typically stock oriented investing, something where you're trying to make 8 to 12% per year on your money, that kind of thing. So when people are young like that, and you have a long time horizon, you can be 100% equity driven,
Right.
stock driven, or aggressive driven, because you're not planning to use the money in the near term. And so if the market drops 40 or 50%, which unfortunately it does periodically, it doesn't matter. You wait for it to come back, and it's painful, but you just move on with it. As people get into their 50s, at that point, we start to talk about a shift, typically adding fixed income. There are different thoughts on this today, because in the last time we had a downturn, fixed income went down just the same as the stocks went down.
Right.
And so the theoretical non-correlation didn't pan out, right? People lost on both ends. And so it did not provide the cushion. Fixed income investing didn't provide the cushion that people normally expect. Interest rates rose in the last 5 years. Stock market went down, bond prices went down, and it didn't cushion you. So bond investing has to be re-envisioned to a certain degree, in terms, and or other fixed income things like passive real estate, for example, can be a very good alternative for people to broaden that stock market risk as they get in their 50s. So, in their 50s, it might be 20% becomes fixed income. In the 60s, you're typically going to talk about 30 to 40%. And so that you go into retirement with maybe 60, maybe 50% equities. And you're still maintaining that much in equities, typically because today we're planning for much longer life expectancies than we
Right.
used to. So my father died at almost 92 years old. He worked till he was 87, so he was an anomaly. He was a college professor, and he was crazy. And he just decided, he would say to me, Tim, I work 12 hours a week, and they pay me a full salary and benefits. Why would I retire, right? And he had a very good point. So, but most people, they're planning for they want to be financially independent. They want the option to work or to do something that may or may not produce income at that point. So at that age, what we're trying to do is have some money still in the stock market, so that we're outpacing inflation nicely over time and able to produce more income later on as inflation drives up their living need. And most fixed income instruments don't go up with inflation. One of the beauties of real estate income is that it does go up with inflation. So that's one of the best inflation hedges for people, in retirement as income instruments go. And it can be privately owned real estate where you have your expertise, for example. It could be some sort of a limited partnership kind of thing if somebody doesn't want to go out and own their own
syndication or
things.
whatever.
Yeah, syndication, you can get, there's plenty of them out there, right?
Yeah, absolutely.
That's sort of my philosophy on it. I have somebody who's 80 now, and she's going to have probably at least 60% fixed income, if not a little more. However, her mother lived to be 97, and we're still trying to make sure we can keep ahead of inflation if she lives to 100. You know what I mean? It's
yeah, absolutely. Yeah, that makes total sense, and thank you for explaining that. I mean, there's one little thing that popped into my head while you were describing it, and that is the subtitle of our show is The Path to Early Retirement, which when you said, like, okay, we're looking at the age and we're looking at the timeline in answering my question. What I'm seeing also with our clients is that they don't really want to, if they don't have to absolutely desperately work till 67, they would rather be done earlier, so to speak.
Sure.
Now, hey, let's take a quick break for a message from our sponsors. If you're serious about growing your wealth, you know the best opportunities aren't always the most obvious. That's why we've partnered with Bob Benodas of Franchise with Bob. He specializes in helping investors like you leverage franchising in an overlooked but highly profitable way to create semi-passive income. And for a limited time, Bob is giving our listeners access to his course on franchise investing for free. Inside, you'll learn how to evaluate franchises, minimize risk, and maximize your returns. This course is normally sold for $499, so don't miss out and claim your free course now at edu.franchisewithbob.com/ideal. As an expert in this, I wanted to ask you, I think, just making an assumption, you can say I'm wrong, that if you look a little bit longer time frame, if you say here somebody is 40 and they're looking until 60, so there's a 20-year time window, I think that would be a fair window. I think it would be fair to say that stocks in that kind of a longer frame on average go up in price or in value consistently. Yes, there are swings in a 20-year time window that could happen 2 or 3 times. I don't think there's ever been more than 3 within 20 years that are really dramatic.
And most of those are around the Depression, which, we hope we won't see something as
I'm just,
drastic as that again. Yeah.
If I'm saying, like 20 to 20, 2000 to 2020, right? You could say at the very end, you had the COVID, at the very beginning, you had the .com, and in the middle, you had the financial crisis. That were 3, right? If you move it just a little, you barely get 2 so far, right?
Yeah.
So what I'm getting at is if you were to say, okay, the average, let's say we go with S&P, is something like 7%, right? Would you agree with that?
I think it's a little higher, but it's in that neighborhood.
Okay. Yeah, well, maybe it's 8 or whatever, but something in that ballpark. What I'm getting at, some kind of interesting idea, and I told you before we started recording that I'm a conviction investor with an enormous portfolio of 2 different stocks. So my audience knows that about me as well. But the point, what I wanted to, since I have an expert like you, to run by the idea, and maybe you can expand and say, is this actually something reasonable? And that is when you get to a point in the lower end of the range that you said, as far as who would be the right clients for you, to basically consider the benefits of using the asset value in your stock portfolio to apply for a line of credit. In the sense that you take the line of credit, let's just say you decide on your $5 million portfolio, you take a 2% line of credit, right? If my math is right, that would give you
100,000. Yes.
Yeah, right. So, and even if you had to pay 10% interest on that, but then you said it's even more than 7%, you could carry that for whenever you want to actually be going into retirement, and basically almost do it every year. And just by the appreciation of your portfolio, you could at the end say, okay, well, I'm just paying the rest off and I have way more than I would ever need, rather than having to somehow do something else with it. So this idea, and you could even go further than 2%. I mean, the fire movement people say 4%. But then you could reinvest actually with some of the money, right? If you're thinking it makes more than 10%, which is probably then really aggressive. But I'm kind of curious what you're thinking
Tesla and
about the
Palantir,
idea.
you never know, right?
No, exactly. Well, I mean, I would be disappointed if they only did 10%.
Right. Yeah. Yeah.
But no, the point why I'm bringing it up is this notion, past to early retirement, even with the stock portfolio, like your kind of target audience. I would think if I'm right about this line of credit for living expenses, you could basically almost determine on your own when you get to this volume of asset value any day, okay, I'm done. I'm just going to live off 100 or 150,000 a year.
Yeah. So there's actually kind of an urban myth, and I'm not sure if it's true or not, that Elon Musk he takes virtually no salary. All he
Yes.
does is
Yeah.
he just borrows against his Tesla
Yeah.
stock.
Right.
He can deduct the interest because it's an investment expense, and he just builds a loan against that Tesla stock instead of taking a salary and paying ordinary income taxes on that salary. So in a sense, he gets free money.
Well, it's also true, if I'm not mistaken, that just from a purely legal perspective, and not talking like a billionaire or whatever, like Elon Musk, but somebody like with 5 million, isn't it true that you could borrow like anywhere up to like 70% of the asset value against it?
Yes. So if you want to buy stocks, 50% is the maximum. If you're going to use it for personal purposes, 70% is the maximum.
Yeah. So even if you say 50% and you only take like two per year,
Yeah.
And obviously that would be also much less than most years inflation, right? So
Yeah.
basically, if you're right that let's say it's 8% for the S&P, you're good all along, right? And yes, every so
Yeah. Yeah.
often there
Yeah.
might be a drop, but unless the drop is 1 year after you start, it would be
Yeah.
really unfortunate. But
Well,
if
but
it's
if you only
like,
have 2%, if you
yeah,
haven't
yeah,
taken
yeah,
out all
no, I
50,
know,
nah, it doesn't matter. Yeah.
right? But
Yeah.
I mean, I'm not saying this because the math would make a difference, but the psychology definitely would
Yeah.
make
Oh, yeah. Yeah. Yeah.
a difference.
Now, just so you know, the downside of that, and this is from a financial advisory standpoint, is that regulators hate it when financial advisors recommend taking on debt.
Mhm.
So there is a now in the old days, financial advisors would recommend that people take on debt to buy more investments, right? That in particular they didn't like, but in general, financial advisors are uh, loath to recommend debt to people or increasing debt unless people really have a lot of money. 5 million might be enough. I would say 20 or 50 million might be more, where you'd get a kind of a friendliness towards that kind of thing. But the math works at any level. So
Yeah,
if you
well,
have
it's also,
two
I
hundred
mean,
thousand dollars,
yeah, it's a little bit funny to me because, as you said, and I'm more on the real estate side. But if you and I were to throw our kind of experience together, and you would do your thing and I would do my thing, I would say, okay, Tim, let's get one of your guys to buy like a $500,000 fourplex, right?
yeah.
2, 3 years old, all nice, all managed, turnkey provided. It's my specialty. They buy that out of sales from stock, and then you don't
Mm-hmm.
have to be the bad guy when I get them a home equity line of credit and they do the same thing.
Well, yes. As a matter of being a fiduciary, right? When you're an investment advisor, you have to do what's in the best interest of the client.
Yeah.
Whichever gives them a lower interest rate is what you should be recommending to them. So
Well,
if
yeah,
and the
obviously.
asset based lending is typically going to be lower than a second mortgage.
It wouldn't be
Any kind of
second, it would be,
secondary financing.
no, it would be first.
Well, if you're going to take a first mortgage, it could end up being the same.
Right. Yeah. The only reason you wouldn't want to take a first mortgage because then it doesn't have the flexibility of a line of credit.
Yeah.
Right. I mean, I would,
Yeah.
if we wanted to be really kind of smart, and for the advanced audience who has watched or listened to the 400 shows that we have already done, you know what I mean, right? Like if we say,
Yeah.
okay, we take 100,000, but we only, or 120,000, but we only need 10,000 a month, then your balance is only 10 and then 20 and then 30 and so forth. It's
Yes.
not 100 like you could take like a mortgage or you
Yep.
take credit, so.
And the other benefit of using the assets, the investment assets, is that you don't have to go through an underwriting process with a bank.
Right. Yeah.
You just get a margin account, you sign an agreement. They'll look at what you're holding, but it's pretty straightforward. And you can have a check book that you write checks against it. And
yeah, exactly. Well, and the beauty
very
is,
easy.
There is one aspect that I found where we would be like a perfect like tag team in that sense, is that the argument that is sometimes brought is that an asset like stocks is so easy to buy and sell, which unless it's fraction real estate, but normal regular real estate where you have the title is not something that you get rid of in a day or two.
Sure.
Right. And I'm not talking intention, just literally the process. Right. So so I'm just saying, like if somebody says, no, Tim, don't do this, that is frowned upon, then you say, I do this with access to a HELOC and leave me alone.
Yeah. Understood.
All right. So if people want to have realized, okay, that Tim would be the right kind of guy and Tim knows his stuff and he even teaches people on how to be better educated in wealth, which it's kind of a shame if you think about that you and I still have to do this because it's not taught in school, but I'm grateful that you're doing it. How can they get in touch with you?
Several ways. So my company, AuroraPW.com, is the website. I'm Tim at AuroraPW.com. Also, they can go to The Financial Dad on YouTube or Instagram. The Instagram handle has an underscore after the final D, so they can see us there and see what we're doing there. And, happy to talk to anybody that is interested in any of these topics.
Yeah, awesome. And we're going to put obviously all those links and stuff into the show notes. And Tim, one completely unrelated question at the end that I ask most people is,
okay,
if you could meet anybody, dead or alive, who would it be and why?
Well, it would be Jesus. And this is only partially religious. I find his life and what it must have been like to have been him to be extremely fascinating. A person who started what is now a 2 billion person movement on the planet 2,000 years ago, it just boggles my mind. And I actually I composed and sang a show about his life. It's about the humanity of Jesus, not the theology. So I find him fascinating, and I personally, I hope I do get a chance to talk to him someday. We'll see. I'd like to wait a little while. And some people would say you can talk to him every day, of course, right? But that would be the person I would love and find most fascinating to be able to talk to.
Yeah. Well, I mean, if you convince Petrus, then you might get.
Yeah. Just got to get past that one guy.
Yeah, there's one gatekeeper, like in every business, when you want to get.
Of course, there's a gatekeeper everywhere.
Everywhere, gatekeeper. All right, Tim, thank you so much, and I hope we can do it again at some point.
Great, thank you.